morning. So looking very, very solid. Vinit Sambre is with us, Head of Equities at DSP Mutual Fund. He's our Market Master of the day. Vinit, good to have you with us here. Thank you very much, as always. Just a quick word, Vinit. I mean, as you're observing things, as you've observed things over the last many years, we find ourselves in a pretty good place, actually, almost too good to be true kind of place, right? You'd kind of be hard-pressed to find, from a corporate and market perspective, hard-pressed to find really stark negatives out there. So how does one approach things? I mean, if you're invested, if you're systematically putting money to work, it's paid off big time. I mean, if you have been investing sporadically, so if jumping into one pocket or that theme or this theme, basically more discretionary in that sense, then it also becomes a point where you need to make a call, what to do. So address that second point first, Vinit.
So I think clearly we all recognize the fact that valuations have reached a high point across the spectrum. I mean, we keep doing analysis of the market and also breaking it down into the sectors. And what we realize versus the last time we spoke, now most of the sectors on a 5-year, on a 10-year, their historical valuation basis, most sectors are trading at a good premium. So, you have now segments, across the segments, you have either rich valuations or frothy valuations. I mean, one has to choose between that. But then how do you deal with this high valuation, considering the fact that, one has to play this whole economic recovery, which one is talking about, the strong macro, which India speaks about. I think the only way to think about is in two formats. One, when one enters the market on the basis of the long-term, bright picture and valuations remaining higher, then definitely one has to stretch their, stay in the market. The longer you stay, I think that will take care, valuations will be taken care by the duration of your stay in the market. That is number one. Number two, I think what we are trying to do is look at across the board two aspects. One is the valuation premium, the other is the business cycles. So because you have most segments trading at rich valuations, we are looking at the business cycles. Wherever the business cycles are at the low, for example, let's say speciality chemical, consumption at the bottom end of the pyramid. These are the segments where the business cycles are at the lows today. Valuations might not have corrected as much, but these valuations, remember, are on low balled earnings. And hence, as and when the cycles mean revert and these segments start performing, I think there will be a scope for relative outperformance. So I think what we are trying to focus on is wherever the business cycles are still giving you comfort in terms of margin of safety. I mean, those are the areas which one should broadly focus on, is the sense.
So you've highlighted two sectors where you believe the business cycle is maybe at the lower end, if not the absolute trough. One is specialty chemicals and the other one is consumption. Any other sectors where you have that comfort that the business cycle is bottoming out?
Yeah, so see, last 2 years, we also saw the pharmaceutical companies not performing well in terms of their overall earnings. And, one of the reasons were extraordinary increases in the raw material prices, extraordinary increases in the cost aspects. So I think those are moderating, and we see that the earnings which have already started recovering, I think those should sustain. And the valuations there also, by the way, have now, earlier it used to be at a discount to the long-term averages, but there also the valuations have, just reached the long-term averages. So one has to be cognizant of the fact, but relatively, I think the sector still seems okay, given the dynamics where it keeps growing at 11-12%, and you have good ROC, which the sector potentially delivers. Likewise, we had been talking about the auto sector overall because of the low cycle since COVID, since 2019, actually. 19 was a peak for the auto sector. And last 2 years, we are seeing recovery across different segments, sub-segments. Passenger vehicle has seen recovery, CV has seen recovery. Two-wheeler is one where the recovery is still not, it has not crossed the previous peak. So, that's one category which maybe we can call it at a cycle which should recover and maybe reach the previous peaks, and hence one could sort of focus on that. So, I think within the consumer basket, one can look at the auto segment, one can look at the more consumer discretionary, the QSRs, where the demand has been slow at the moment. So I think one needs to sort of identify the pockets which have been slow, and hence the scope for improvement as the overall recovery, improves their performance as well.
Okay. Vinit, hi, good morning and season's greetings to you. I'm going to go back to that point you made on specialty chemicals, because it is such a complicated class of stocks and companies, right? You need to be, half a chemistry expert, if not a full one, to actually invest properly. So just expand on that. I was reading a report, one of the brokers put out a report saying some of the oleochemicals players, for instance, Galaxy and, Fine Organics, so these guys, they could do better off because there's lesser competition, likely lesser competition from other Asian countries. But within specialty, where would you start nibbling in, looking at ground level business dynamics and the opportunity?
Actually, you're right. The more we look at each companies, we realize that each of the company is actually sector in itself. You'll have companies talking, speaking themselves as specialty chemicals, but they're targeting different sub-segments, fluorochemical, and the likes. So I think the only way to sort of deal with some of these businesses that you have to understand each of these business dynamics in detail as a separate industry altogether, and hence one can't club the whole specialty chemical pack into one view. But let me say this: the parameters which we have used to sort of think about these companies is, one, definitely we have an eye on their long-term outlook, and which is actually demonstrated by their capital spends which they have been carrying out over the last 2-3 years. And I think there is a good amount of visible signs that globally people want to actually look at an option diversifying from, let's say, China as a country. So I think these companies have set up capacities. At the same time, it has got actually, unfortunately, clubbed with a global slowdown in the agrochemical space, which is a large, consumer market for them. So I think as the supply chains there recover, these companies will start performing well. So the metrics which we have been using is that companies which have been strong on capital efficiencies, which mean ROC, companies which have spent good amount of capex over the last 2-3 years, I think those should form maybe your choice of companies to look for in the next 3-4 years.
Okay, so you've not identified the separate subsectors per se, like, I don't know, refrigerants or there's agrochemical players, and there are, some of the pharma intermediary chemical companies as well. So you're not looking at it in terms of subsectors. You're looking at it more from the point of, capital deployment and capex and so on and so forth. Is that right?
Yeah, because as you mentioned, we are not chemical specialists, so we have to go by the financial metrics, which gives us those confidence about the business.
Okay, what about IT? Do you have any confidence that IT is close to bottoming out in terms of demand? Because recently the news flow has been negative, whether it's a contract or an MOU cancellation for one of the large players. So what's the demand environment looking like, and when do you think that business cycle will bottom out?
So, see, IT actually overall, the outlook, generally I tend to remain positive on IT sector because it's a massive cash, throwing sector. It gives out good amount of dividend. And I think the sustainability of the growth over long term looks pretty sound and visible for these companies. But I think we have come in a bit of a slow environment right now for the IT space, and on the back of macroeconomic outlook changing starting next year because of the interest fall in the US market, I think the IT has seen of late rally, which to me seems slightly unjustified given the current slowdown which the segment is going through. And maybe we have 2 or 3 quarters where these companies will have to maybe see some bit of challenge as far as the growth is concerned. And beyond that, I think that bottoming out process should take place is my sense. So IT long-term view positive, but I think the near-term one has to be careful with the valuations, especially the fact that the challenge in terms of the growth is going to remain over the next 2 or 3 quarters. It looks like.
Vinit, PSUs, we have to ask you this question, and I think it's the toughest question that everybody's grappling with. You feel scared when you are buying a stock which is already up 200, 250%. But if you don't buy it, it goes up another 50% and then you feel silly. So I think, help us out here. What should investors do with PSUs in 2024?
No. So I think the way to assess PSUs maybe is to have high benchmarks for them in terms of the expectation of performance from them. And clearly, the companies which cross those high benchmark are the ones which one can hold, because over a long period of time, we have seen PSUs not having created, wealth, when we look at the long term. But the last 2-3 years, there has been a massive change. So we are actually open to look at PSUs where fundamentals are improving. The growth matrix is looking sound. For example, defense companies, the companies within the power value chain. These are the companies where I believe that the environment has become pretty positive. The balance sheets for these companies are also pretty sound and not worrisome. And hence, I think given that some of these space will continue to show good growth, it is reasonable to remain in some of these PSUs. But definitely PSUs which do not give out strong financial metrics, I think one should continue to avoid, or where one feels that the volatility in terms of regulation affecting their business is going to remain high. I mean, those are the ones which one can clearly avoid.
Okay, thank you, Vinit, for joining in. Have a lovely new year, and we look forward to chatting with you in 2024. Let's see. Let's hope 2024 is as charitable as 2023 has been. Thank you very much for joining in.